Hello and welcome. You're watching News 9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. Let's begin with Indian markets first. Suyash Maheshwari here in the studio. Suyash, markets opening on a flattish green note this morning.
Yes, Shweta. So the markets opened on a flattish note with a positive bias amid a positive handover from the US markets, which are on a 4-day winning streak. Okay. Now, since the opening, where Nifty opened above the 19,800 levels, we have seen a fair bit of correction. In fact, currently the market Nifty is down about 0.2% and it has slipped below the 19,800 mark, and Sensex is also down about 15-20 points and it has also slipped below the 66,500 mark.
All right, a flattish opening there for Indian markets. Devang Mehta, Director, Equity Advisory, Spark Private Wealth, joining us here. Devang, thank you very much, sir, for taking time out. It's been a while since we last saw you. Run us through, what are you making of markets this week? A lot of cues, earnings season has kick-started. How are you expecting market? In which direction will the pendulum swing?
Hi, thanks for having me on the show. Good morning to both of you. Yes, clearly, I think what we have seen over the last few days is a bit of volatility that has come into the proceedings, right? That started more with the war which is right now going on. I think, yes, there was a little bit of sell-off which we saw on the first day when global markets also corrected. Post that, most of the markets have sort of recovered from the initial blow. I think crude has also sort of not shown that type of behavior which was earlier expected. I think there is a lot of flows in the domestic markets, in the domestic investors just putting a lot of money into the markets. And yesterday, I'm very sure you would have seen the SIP figures which crossed around 16,000 crores. Now, this has been a revolution in terms of Indian investor coming to the fore, the Indian retail investor, the Indian HNI. Everybody is sort of investing via mutual funds or PMSs or direct businesses. I think this is auguring extremely well. I think our markets are more and more getting self-reliant and self-dependent. That if FII outflow are going to come, probably I think we would be having a good cushion with domestic investments. Yes, earnings season, as you rightly said, all eyes are on the earnings season. Yesterday, TCS reported its numbers. I think it's just the start of the earnings season. The sense one gets is that a lot of sectors would come up with a decent set of numbers, and I think we are in a time when there are earnings which have started to come back as well.
Now, Mr. Mehta, do you expect that the focus which will be on stocks and sectors, because of the earnings season, last time around in the first quarter earnings, we saw that the Nifty, because of this movement, was able to, scale new highs of about 19,990 levels. Do you expect Nifty to make a dash to record highs in this earnings season?
So yes, it's very speculative to say whether Nifty would make a new high, but the sense one gets is that you are typically near the new highs, right? So you just crossed 20,000, 20,200 and then sort of retraced back, and I think these levels are never sacrosanct, right? So they are just sentimental levels to sort of track with. I think more so I'm very happy that the broader markets have also not corrected big time. There are good sectors, there are good businesses in the mid cap and the small cap space as well. So I think there is a decent bit of traction in the markets where across the board correction has not happened. Yes, there have been certain corrections, there's been sector rotation. To answer your question, I don't feel there will be a huge correction in the markets. Yes, probably if the earnings season is good, more so the commentary and the body language of the managements are robust. My sense is that yes, we are on a structural bull run. We are in a structural bull run. Yes, levels will be sort of broken and records are made to be broken. So that's the sense that I get.
All right, and before we move to and deeply into the earnings season as it kick-started yesterday with TCS, one question on the global markets the kind of trajectory that they've seen in the past 4 days, start of Monday's session. There was a sense that markets will react negatively to the pressure and the shock of a war in West Asia. That hasn't really happened. Recovery across European market, US market and Asian market. Do you expect that sort of bull run and recovery to continue?
And to add to that, US markets never actually fell, they have been on one of their best runs in, the recent memory. 4 days they have, added gains.
So, you said something very interesting. You said markets are becoming increasingly self-sufficient. Is that the case with Indian markets, but also perhaps with global markets all across the world? It doesn't matter to us as long as it's not our war.
I think the market is sort of a discounting mechanism, right? So we always say that market discount itself a little ahead of the events. So the sense one gets is that at any point, if you take out the last 3, 4, 5 wars, the data from the last 3, 4, 5 wars or this type of war-induced behavior, I think in the last 20, 25 years, we have seen a knee-jerk reaction happens on the first day. Maybe it lasts for a week and then market again starts to rally back. I think Russia-Ukraine was a classic case again. Then we saw a bit of correction. We saw crude also sort of making sort of creating headwinds for countries like India and energy importing nations or other crude importing nations. But mostly market finds its feet again. And finally, what we also always notice is market is a slave of earnings, right? So if earnings start coming good, if there is liquidity in Indian markets, there is a good sentiment prevailing for equity as an asset class, and if there is good earnings which are going to come, which solves the macro as well as the micro fundamentals, I don't think there is much to worry right now.
All right, and let's quickly then move on to what's happening in India by the way of an earnings season that has unfolded with TCS as of last evening. TCS results are surprising to a lot of people. In a way, it's a mixed bag. So far the commentary that has come in for IT Pack, Suyash, is it's going to be a washout, it's going to be better than expected. What do the results tell us to begin with?
As you correctly said, Shweta, it has been a mixed bag. And if you look at the stock also, Shweta, the TCS stock was near its 52-week highs earlier this week. And, the expectations of a muted result did affect, the stock prices. And we saw some pullback there. In fact, even today, the stock is down about 1.5% or so. But before we talk about the hits and the misses, the good and the bad, let's look at the, the headline numbers for TCS. Now, if you look at TCS's Q2 earnings report card, yes. So revenue saw about a 0.5% jump on a quarter-on-quarter basis. It came in at 59,692 crores versus 59,381 crores in Q1. Net profit was around, saw a spike of about 2.42% from 11,074 crores to about 11,342 crores. Also, the net operating profit margins showed a good improvement, Shweta. It improved by about 110 basis points on a quarter-on-quarter basis to 24.3% in Q2 versus 23.2% in Q1. Now, let's talk about what was the good and the bad from TCS's results. Let's look at the hits first. The net profit figure has beaten estimates and it came in, the expectation was of about a 0.8% quarter-on-quarter rise, but the results we saw a 2.42% rise. Operating margin, Shweta, also has seen, as I mentioned earlier, a good bit of bump up. Now this is on the back of cost optimization efforts undertaken by the company, and also we have seen that it has recovered from the wage hike cycle, which was a pain point for the company's margins in Q1. Order book also remains strong. Now TCS's order book came in at the total contract value of about $11.2 billion. Now this was mostly in line with what the street was expecting. But we also saw a good uptick from the BFSI segment, which is a major contributor for TCS, and it is the second highest total contract value on in a particular quarter. Now let's also talk about what was not so good. Before that, let's also look at the attrition rate. Attrition rate has come in about 3% lower on quarter-on-quarter basis. On a year-on-year basis, it has declined by 6.6%, which is a 660 basis point correction. Also, if we look at the misses for this quarter, revenue growth, Shweta, was a major disappointment for the company. In Q2, revenue growth fell short. It was expected to be around 1.3% on a quarter-on-quarter basis. It came in at around 0.52%. Although the attrition rate came down for the company, the head count for the company went down by about 6,333 people. Now, if you remember, back in Q1, TCS was the only company which saw a rise in the head count. But this quarter, we have seen a decline of about 6,333 in the total head count of the company.
That is as far as hits and misses is concerned. Let's quickly get in Devang for, what were the biggest hits as, in your assessment, Devang? Revenue in line with estimates, closely in line with estimates, but missing the guidance and missing what the company was expecting. 1.3% comes at 5.52%. Not a big bummer there, is it?
I think more or less the results were on the expected lines. Yes, I think the revenues were quite in line, as you rightly said. A good surprise was a slight bit of expansion in terms of margins. The deal wins as well as across the geographies, I think whatever they have won, whatever order bookings they have done, and whatever the order flow has been, it's been a robust pipeline of orders as well. Yes, we all know that there is going to be a slowdown, exactly an expected slowdown across geographies in Europe as well as in US. So ideally, yes, the management body language and commentary was not as such very weak. But you can't expect a sort of a bumper type of quarters for the next 2-3 quarters at least, and on a high base for companies like TCS and Infosys to deliver some great sort of numbers would be difficult. But my sense is that the correction that the IT sector went through is sort of over. The valuation correction also has sort of happened. Now probably from here on it would at least be a market performer, if not a outperformer.
All right. And before I let in Suyash come in, as far as attrition is concerned, because that's the story in the IT sector we've been tracking, although attrition rate is down, the headcount is also down by over 6,000 people, which essentially means no new hiring in second quarter.
And given that, the company has seen such massive deal wins, all the deal wins are, these contracts are long duration contracts. So, to carry out those contracts over the next few years, you need not only to retain the talent, but also hire new people.
Devang?
Yes, exactly. So I think probably they in one quarter it sort of should be a blip. Attrition coming down is one, I guess, a good thing. Yes, they are not probably headhunting or the recruitment has not been so strong. Yes, that probably could be a little bit of a blip this quarter. But my sense is that yes, the type of deal pipeline they have, the long-term contracts that they have won over the last 3-6 month period, and also the visibility towards that will surely they would probably have some pipeline of people who would be joining them. So I don't think this is a huge negative as such, and also I feel that markets wouldn't behave irrationally as such, because TCS has also announced a buyback at 4150, which is quite a high price from the market rate which it is right now at, and this companies have a lot of cash sort of where they reward the investors with either buybacks and good dividends.
Now, Devang, we also saw there was a report that, in fact, TCS itself said that 250 of its employees are currently stuck in Israel. Do you think that, news factor to have a sentimental impact on the stock prices?
I think, Suyash, that impact, if it was about to come, would have sort of come early in the morning as well. So I don't read too much into it. Of course, probably the safety and security of those 250 people is of utmost importance rather than the market behavior. I don't think there would be any sort of problem, because there are sort of thousands of employees which work with TCS, and how much is sort of the Israel part of this global revenues that needs to be seen. But I don't think there will be a huge deterrent for the stock.
Now, before we move on to buyback, I also want to touch on the result expectations of Infosys and HCL. Any inferences that we can draw from the results of TCS? Any sneak peek that you can give us?
Ideally, I think, most of these results will be more or less in line. Ideally, some of them would be around, say, 0% to around 3-4% type of constant currency type of growth, which they would see in. I'm more wanting to know what the management comments about the next couple of quarters. Of course, the market probably does not read much into numbers because it's already done, right? So it would be sort of a reactive move on the stock on the back of numbers. But I think what the management speaks about, whether IT is slowing down, whether the BFSI sector there is slowing down, the answer seems to be no. There can be certain problems with telecom as well as retail sector. I was reading a lot about the retail sector. They're probably slowing down. telecom, that there is an inflationary trend which still is sort of prevailing over there. And we know that higher for longer interest rates are also the flavor of the season there. So I think a little bit of slowdown, if the companies talk about in the retail and telecom vertical, there would be a little bit of jitters for some of these businesses. But ideally, as I said, more so wouldn't like to speculate on the numbers. Want to listen to the management commentary, the transcript very carefully, word by word, reading between the lines, and that's where I think we would take our call after the earnings are coming.
Now, also looking at the order win, TCS's total contract value at the end of the Q2 stood at around $11.2 billion. Does it give you any sort of confidence that, heading into FY25, perhaps we can see, the entire IT pack seeing a double-digit growth, which it was on before the last few quarters?
I think yes, I feel a little bit energized when I look at decent type of numbers from this table when the commentary is not so weak. This sector has sort of earlier underperformed. If you look back 1.5 years back, it has sort of underperformed the broader markets. I think last 2 or 3 months, it's outperformed the Nifty very well. And my sense is that if you want a sort of an exposure to sort of global markets, a company, IT services in India is sort of companies with durable competitive advantage. I don't think that one can ignore if somebody wants large cap businesses in the portfolio. These are sort of businesses you go to. Of course, you can't be the best timer, but the sense one gets is yes, they are on a decent trajectory. And once this slowdown, recession things calms down in the next 2, 3, 4 quarters, hopefully, I think things would sort of get smoothened out for this sector as well.
All right. And when do you expect things to smoothen out? Over the course of next 2, 3 quarters or starting next quarter? I mean, talking about the deals and the contract book for all companies, we've been discussing in and out over the course of last 2 days. When the order book looks that lucrative and the deal size is becoming bigger and bigger, when do you expect it to show results? Maybe next quarter, or we'll have to wait for a couple of more quarters?
I think the trajectory seems to be on an upward side. Why I would reserve my comment for this, because what we want is not only a good deal pipeline as well as good order execution, but also at a decent margins. A compromise on margins never sort of excites the market participants, and of course it's a huge deterrent for the business as well. So if there is a competitive intensity where companies sort of crack their margins and garner business, they need to do it sometimes. But ideally, that's not the best scenario that we know, because see, ideally, if you want a volume business or you want a margin business, and the combination of both is great for the market, right? That's what you call a durable competitive advantage business. So the sense one gets is that if the margin also comes back, which we saw this quarter, it should not be a one-off quarter where we see this phenomenon. But if the margins are also maintained along with the order wins and the deal wins, I think that's where we would sort of want to be a little more constructive on this sector.
Now, Mr. Mehta, talking about the buyback of the, that the company has also announced, it has announced a buyback of about 17,000 crore at the price of 4,050 per share. Now, the overall size of the buyback is lower than what, the company had announced back in January 2022, and the offer price, the buyback price is also lower. What do you make of it?
I think, see, it's higher by 15% than the yesterday's price. It's at 4150. 15% higher than the price which it commands in the market right now, or rather on October 11, is not a bad sort of pricing for anybody who wants to sort of give in. But I think again, most of these companies, we have always seen that the earlier buyback was somewhere around 3,200, if my memory serves me right. Most of these companies crossed their earlier prices. Just a case in point, right? L&T had earlier announced a buyback around 3,000, and then it sort of revised its buyback price at 3,200. The stock already would be somewhere around 3,100. So I think good companies, when they announce buybacks, it shows positivity amongst the management. Yes, also the equity gets sort of wiped out in a way. So my sense is that the buyback is at decent prices. It also encourages the investors, sort of long-term investors, those who are not willing to give in buyback. They also know that the company is doing very well, so the management is confident to take shares back at 4150. So I think it's a positive. I don't read much negative print into it.
Now, Mr. Mehta, the company has announced, around 5 buybacks in the span of 6 years or so. And when typically a company announces a buyback, it's either because they think that the price of the market price of their shares are undervalued, or the second line of thought could be they are lacking that investment opportunities. What do you think is the case here?
See, I'll clearly demarcate it from this, because the second thing, the second option which you talked about, they don't have many sort of cash using opportunities, if I put it that way. I think IT companies either make some inorganic acquisitions, which some of these companies have been able to do. They have sort of been successful in doing that as well. But most of these IT companies, FMCG companies, they create a lot of cash. I think there's a good strategy to give it to investors back, that look, we are confident that our business is doing well, and over a period our business will sort of do well. So my sense is that it's more of IT companies or FMCG companies, whenever they do buyback, whenever they give good dividends, it augurs very well for the investors. Whereas a capital good companies, an infra company, they would sort of use their cash for other projects, and sort of their internal accruals also they would use for expansion of projects or do capex, which I don't feel is right now the case with IT, which is sort of again envisaging a slowdown across the global markets or the geographies where it serves. So it's a good thing right now when there is a buyback, when there is a special dividend, whenever a company announces bonus. Of course, I know more of this are accounting entries like bonus, but it sort of serves the investors as a good, confident, positive momentum to stay invested.
All right, and Devang, before we let you go, a lot of results, IT results awaited, will come in the next couple of days. HCL, Infosys. What is your big expectation as far as IT pack is concerned? Do you agree it's going to be a washout here, or do you think it's going to be a mixed bag? And
what will you be looking from the management commentary as well?
I think IT as a sector, probably this is one quarter which everybody is looking at, because there seems to be a positive sort of glimpse into numbers, as we saw a little bit of margin expansion. Deal wins, we all know, over the last 1 or 2 quarters have been decent. What we want to hear is across geographies and across sectors in those geographies as well. What are the hits and misses? Whether they are confident of sort of getting more orders, whether they are sort of confident of executing these orders smoothly, also whether they would be able to maintain their margins. I think these answers wouldn't be found in this one quarterly commentary, but over the next 2 quarters, I think the management commentary and the body language as such would be very, very useful to sort of know. So as I said, not much into the numbers, but more into the commentary about the geographies where they are serving, which sectors are either slowing down or which sectors are showing a bit of momentum to come back. That would be the key factors that one would look to watch for.
All right. So margins over volume and geographies over what numbers come out, absolute numbers in second quarter. Also, next couple of quarters to look out for. I think that is, Devang Mehta's commentary on IT Pack. Devang, thank you very much for taking time out, sir. Appreciate you taking time out for joining us here on News 9. And moving on to a story that we continue to track by the way of a widening probe on Adani Group by the way of SEBI's new latest efforts to also figure out whether the OCCRP report on Adani had any merits, whether Adani Group of companies has been in violation of a number of allegations that have been leveled on Adani. Let me quickly bring in my colleagues Amit Ranjan, Karthik Malhotra to walk into the studio and also enlighten us of what Adani's latest issues are and what could be in pipeline. Let's quickly begin with the report, the crucial report that came by the way of, and after Hindenburg, the OCCRP report that made some serious allegation. It now appears that SEBI has taken those allegations seriously, will be probing Adani.
No, this probe, the new probe, is part of the SEBI probe into Adani post the January Hindenburg report.
Okay.
So obviously OCCRP is a sort of a monkey that just doesn't seem to leave the back of Adani. The fund has, this report has alleged that the fund has investments in several Adani listed companies.
Okay.
Now the core question that SEBI is probing is whether the fund was acting, quote unquote, in concert with Adani shareholders. So, in that way, was it violating the shareholder basically agreement rules? This fund is set up, is called basically Gulf Asia Trade and Investment Fund. It is set up in the, incorporated in the British Virgin Islands. It's owned by a Dubai-based businessman, Nasir Ali Shaban Ahali. So Adani is nowhere there, but it seems that lot of, this fund has a lot of investments into a lot of Adani firms. That is what OCCRP report is alleging. SEBI is probing whether it is violating share ownership rules.
All right.
So that is the whole this thing, and whether it is acting in concert with Adani shareholders.
Okay. So the, you know, would you be in agreement when I say this probe has moved beyond Hindenburg allegations?
Absolutely. I think, you know, there were suggestions being made in the commentary that was coming from the Adani Group after the OCCRP, which is a George Soros funded project of independent investigative journalists. When that report was released, it was said in statements by the Adani Group that it's actually a rehash of the Adani Hindenburg saga, the Hindenburg research report, which had alleged short selling, you know, on Adani. Now, OCCRP had, for the first time, named this gentleman, the Dubai-based businessman, and had named Gulf Asia Trade and Investment Firm as perhaps working in cohorts with the Adani Group because of the association with Gautam Adani's brother Vinod Adani, and the two people that the OCCRP report had then named, including Mr. Ahil, you know, which also comes up as one of the main opaque structure final beneficiary entities of the Gulf Investment Board. Now, I think SEBI has taken cognizance of the OCCRP report. And the inquiry, the investigation, the probe has widened as well as deepened. Now, the point is that SEBI till now has not been able to, in Supreme Court, present its investigation, its report. And that date has been deferred, and 13th October, if I remember, was to be the final date of presenting that investigation. We are on 12th of October today. So is that really going to meet its deadline again? We don't know now with this widening of the probe, and this incidentally has been reported by Reuters, which is suggesting that SEBI is widening its probe, and the OCCRP investigation is definitely finding some merit in the attention of SEBI to actually investigate whether shareholder norms were violated, because 25% of shareholding in a publicly listed company has to be held by the public. And it seems that this particular investment arm, whose website has actually been taken down ever since OCCRP reported the matter, could be in violation of the 25% minimum public shareholding pattern.
All right. So Adani Group of companies could be in violation of the minimum shareholding pattern through the Gulf Asia Fund, in which the allegation is that the owner of the fund is in cahoots with Gautam Adani.
Absolutely right.
And you know, let me refresh our viewers' memory to what the allegations are as far as Hindenburg is concerned. The allegations are, you know, stock market manipulation and accounting fraud. A probe by SEBI is continuing, and we don't know whether a report has been filed. So questions need to be asked of SEBI as well, Karthik, at this point in time. Where is the report? It's been an ongoing investigation, been over a year, at least been 9 months since we've heard of the allegations. No report in sight just as yet.
Absolutely, Shweta, and I think no doubt SEBI needs to be pulled up. SEBI's socks need to be pulled up, and there has to be accountability on SEBI itself, that as the market regulator, where are your teeth? I mean, are these the tusks of a tusker just to show, or do you actually have teeth to bite? I think that question has been hanging in suspended animation for years.
Very long now.
And not just with respect to the Adani Group allegations and investigations, but I think overall the larger question on whether SEBI has teeth to bite, and whether SEBI should proactively, and it has investigated Adani proactively since 2014. But what happened to those investigations? What happened to those probes? And why is it that we are still sitting on 12th of October 2023, more than almost 10 months after the Adani Hindenburg research report came out, and thereafter 2 months after the OCCRP report has come out, and we still don't have any direction from SEBI on whether there was fraud or not?
And you know, a lot of commentary out there from a lot of analysts and experts is that wait for that court hearing to figure out or to know for certainty whether Adani is guilty or not, because SEBI is going to file its report in the court. But SEBI also has a duty towards investors to come out clean, say whether Adani is at fault and not at fault.
The primary role of a market regulator is to
investors.
protect investors, shareholders. And I think that protection has to come quick. You know, it can't be, yeah, we will protect you, we are protecting you, we will get there, but you don't get there.
Absolutely.
So, I don't know what pressure SEBI also could be under. And we don't know, you know, if these delays by SEBI are actually the delays on account of the ongoing investigation being complex, the opaque structures of companies, you know, operating outside the shores of India and the limited jurisdiction that SEBI would have on those companies, or are there other pressures on SEBI due to which these delays, despite perhaps investigations being concluded, are not surfacing. So difficult to comment or speculate on that right now.
This company is in the British Virgin Islands, so that is a difficult
terrain to, of course, a very difficult terrain there to figure out whether the ownership pattern of the company. But SEBI needs to come out, and needs to come out very clean and very, very quickly to either give a clean chit to Adani or to state for a fact that Adani Group of companies was in fact violation of the law. But shifting focus now to a story we are tracking by the way of Go First, it looks like there is a buyer.
Yeah, there's an expression of interest, and the only expression of interest that has been accepted by the banks, by World One, which is a Naveen Jindal company, which owns Jindal Power, which has submitted the expression of interest. So now, this does not confirm a financial bid, but after this has been accepted. So now, Jindal Power will be doing due diligence, and after that, will be submitting a formal report for its bid to take over Go First.
All right.
It's a new territory for Jindal.
Okay, new territory for Jindal. Very, very surprisingly, there is a bid that's actually met all the criteria, and that has come by the way of Jindal Power. There may have been more bids, but they did not meet the criteria. These are the news reports, very preliminary sort of news reports that we are getting at this point, where Jindal could or is likely to be a prospective buyer for Go First. It's yet to finalize the bid, but the process has started. with the expression of interest. You know, Go First saga, and since we've discussed it for far too long, let's quickly revise what we know so far. So Go First, we know that there is a temporary resolution professional who is looking into the day-to-day affairs of Go First. We don't know whether it's going to come back anytime soon though.
I mean, I think
we've been talking about it forever now.
There is initiation, the expression of interest. I mean, it reaffirms the faith, for whatever reason, that entrepreneurs and businessmen have in profits arising out of aviation, you know, which have been elusive up until now across the board, barring very, very few examples, Indigo being the prime example there. But yeah, Go First has remained grounded since 2nd of May this year. It's been more than 5 months that the airline has not taken off. We did see there were issues between lessors of the aircraft, and Go First, when the NCLT had actually put a hold on lessors repossessing their aircraft. Now, that confusion also got clarified, partly that subsequent insolvency petitions at NCLT will allow lessors to take aircraft back. But until then, whether that would be applicable retrospectively in the case of Go First or not, we don't know. But the fact is that, yeah, there is one EOI, and that EOI comes by way of Jindal Power, it comes by way of Naveen Jindal. And now I think it's a function of due diligence, it's a function of negotiation, and the onus is really on the resolution professional to be able to arrive at a deal which works in favor of whatever liabilities Go First has, which are fairly humongous, and the interests of Naveen Jindal's Jindal Power, which is hoping to perhaps control stake in Go First. Now, how long that's going to take, how long the negotiations will take, what is the price at which Naveen Jindal would be willing to take on the liabilities of Go First, and thereafter the operational cost, the sustained cost, paying salaries, keeping hangars, keeping, all other infrastructure intact, restarting the airline, taking it back to the skies. It's definitely not happening soon. It's definitely not happening soon. Can we put a timeline to it? No. I would perhaps say at least another quarter until we see some direction on a firmer
You're giving it a
timeline.
quarter?
But no, I'm saying not a quarter before it takes off, but a quarter at least to get a sense of which direction and what sort of a timeline will it eventually, unfold into.
And you briefly touched upon the changes in insolvency rules, which will allow lessors to repossess the aircraft. If that happens, the existing fleet of Go First will almost be halved.
So we don't know whether that is going to happen retrospectively, which means on cases which are already
ongoing,
at NCLT
right.
stroke NCLAT, and whether IBC, the new change in the IBC Rule 19, if I'm not mistaken, is going to supersede the directives of the NCLAT, or it's going to be only for fresh applications coming in for insolvency. I think if the rule has been changed, two fears. One fear is that perhaps, the NCLT, NCLAT and the IBC expects more insolvency cases in aviation to hit them. And hence keep the interest and keep the interest of lessors intact, so that those airlines which continue to fly and continue to be operational profitability and margins and market share wise or not should not get impacted. Or perhaps it could be implemented retrospectively that, okay, this is a problem, airlines stuck with us right now. Let's keep the lessors happy, take your aircraft back. We'll figure out through the resolution professional on whether we should sell it, whether it should continue for longer in this coma state, and where it should go. So we don't know whether it will be retrospective or not.
I'm hoping no more airlines tank anymore.
We've
seen
seen
enough of
hoping
them.
That, especially those who run the aircraft, the airlines, but the market is fairly difficult to operate in.
As a consumer, I would want more airlines and more options, perhaps. We don't know whether that's going to happen. But let's move on. Let's shift focus to an active ongoing war that is currently panning out at full force in West of Asia. The impact of the war on world economy of Israel, India's inflation expectations, and more importantly, the FOMC's minutes of the meeting that came out last night. What does it mean for the global economy that many seems to say is limping towards some fruition, some positive start, but the war could set it back? To discuss that is joining us Vivek Kumar, economist at QuantEco. Vivek, thank you for taking time out. It's been a while since we last spoke. A lot has changed primarily by the war, of an active war that is raging in West of Asia. There is commentary coming in from IMF at this point that the war could set us back. The limping world economy could be set back by the way of this active war. What sort of impact are you expecting on the world economy?
Hi, good morning, and thank you for having me on the show back. And I think that's a question which is weighing on the policymakers' mind as well as all the economic stakeholders. Now, what we know as of now is that while yes, there is a concern, the war does not really, the affected regions directly do not control any vital nodal points for the commodity market trade, especially the crude oil market. So as of now, the impact on the market rates, so whether you look at commodity markets or equity markets or in fact even bond market, the impact so far has been pretty mute, I would say. If I can take you back about a month, then the oil markets were reeling under the pressure from OPEC supply cuts. So we saw Brent price moving all the way up to closer to 90-95. In fact, I think it had also crossed 95 for a very brief period of time. And since then, last 2 or 3 weeks, it corrected sharply by as much as $10, and prices came down from 95 to 85 within the span of 2 to 3 weeks. Now, since this news has come about, the prices would have risen by about $4 to $5. So we've given up all our gains in terms of price correction, and now we are back to closer to 87, 88 dollars per barrel. So we are down from the recent peak that we saw, but there is a zone of uncertainty. There is a zone of, I would say, unease as far as the commodity markets are concerned, because for India, the primary source of contagion, if at all it were to escalate, will be via the commodity price angle, and especially within the commodity price basket, it will be the petroleum or the crude products.
Vivek, hi, good morning. Thanks for joining us today. Karthik this side. Let's take two scenarios. One scenario that crude oil continues to be below $100. I'll not say that, let's assume the best case scenario that it stays within the 87, 88, under 90 range. Let's assume it stays at $100 a barrel. Then I think that is a price that all global economies have factored in when they are making their projections for inflation and rate cycles, as central banks would want to sort of continue with. But second scenario, so question one, if $100 and below is the crude oil price, then is there going to be any other impact on global economy with the ongoing war? And the second being that the peak of 120 that was arrived at during the start of the Russia-Ukraine war last year, if we were to come back to those levels or beyond those levels, then how drastically does the inflation print change?
Hi, Karthik. Good morning. So I think that's a fair range that you said, because most of the market participants at this point in time are working with a $90 to $100 range as far as Brent is concerned. Does that upset the arithmetic? If that's the question, I would say that probably does not, because it's kind of baked in most of the forecasts that the markets are currently making, as well as the policymakers' forecast. In case of RBI, they are slightly lower in terms of their projections. They are penciling in close to $85 to a barrel for the year as a whole. And for the first 6 months of the year, the oil forecast was actually lower than the forecast that they were making. So even if oil were to trade at 90 or closer to 90 levels, their forecast of $85 to a barrel for the year will be met. Now, if it were to be in the 90 to 100 range, I would say it's not going to upset the arithmetic a lot. Reason being, the previous financial year, we were at 95. And if we end somewhere close to that level, then we would be very even Stevens as far as the last year's scenario is concerned. So most of the metrics that you would be looking at would be in percentage terms. And when you look at it from percentage terms, it does not really change a lot. The picture does not really change a lot. So what will change in the interim is the worsening of price situation vis-a-vis the previous quarter. The previous quarter, the markets were in the comfort zone of 75, in fact, less than $80 a barrel. So that comfort zone, you are no longer in that comfort zone, and you are now in I would say, an amber zone. You're not really a red zone yet, but kind of an amber zone. So what really would be a red zone? A red zone would be the thing that you highlighted, something closer to 820 or maybe above would be a red zone for the global economy. So why would it be? It would be because there is even without this, there is an expectation of a slowdown. And if oil prices were to escalate, the slowdown will only get worse. So that is something that we'll have to keep in mind, and we would be exposed from the trade angle. Our current account deficit will feel that pinch. Our inflation metrics, unfortunately, might not reflect the true reality, Karthik, here, because we've got two sets of inflation indices. One is WPI, one is CPI.
Yeah.
And all said and done, we are going to enter the busy election season very soon. So the government will probably use its discretion. When I say government, I also include the oil marketing companies, because they are government-owned entities.
Right.
And so they would use the discretion to decide how much of the pass-through is likely to happen during the upcoming election season. So it is going to be discretionary at this point in time. And I guess while the impact will be there, the impact could be borne by either the government or the oil marketing companies on the retail side. On the wholesale side, the impact could be closer to, let's say, complete. So that's probably the reason why we would expect a much faster acceleration in WPI inflation, which is the wholesale rate, where you will see the impact getting captured on a regular basis. On the retail side, it's likely to be muted. So, for example, last 1 month of picture tells us that the government is in the mood to cut down prices. If you look at LPG, and there was an expectation that in the upcoming election season there could be a possibility of government also lowering excise duty on petrol and diesel. Now, if oil prices were to stay elevated, then maybe that expectation will get curbed. Maybe that is something that might not play out. But as far as the pass-through to CPI inflation is concerned, we would not be very optimistic that's something going to happen within the next 4-5 months.
Okay,
right.
and let's talk about US. I think, the FOMC meeting minutes that came out last night have pretty much expired because it is last month's commentary which did not factor in the war. So I think the minutes are expired right at the start of their release. But overall, this whole higher for longer cycle, does it now likely to remain much higher for a much longer period of time, or
is it going to be lower? Because there's been mixed commentary coming in from Fed officials as well over the course of last 2 to 3 days that higher bond yields mean that our inflation targets have changed now. So perhaps not too hawkish in the near term.
But
what
again,
is the trajectory?
before the war, so
and before the war,
so
of course. Lot has changed in the past couple of days.
You're right, Feta. In the last 3-4 days, few of the dovish members in the FOMC, they made this commentary that high bond yields are doing part of the job. So essentially, when they say that high bond yields are doing part of the job, then bond yields start to correct, wherein they start expecting that the Fed is sounding okay as far as further interest rate tightening is concerned. And this means that November rate hike is not there on the table probably. So when you say that, then the bond yields start correcting, and the moment bond yields start to correct, which they have, fallen from almost 4.885 levels to closer to 4.5, 4.6 range now on the 10-year. So the moment that starts happening, then the argument turns upside down. So it's basically a circular argument that you keep chasing. You say it's too high, maybe we'll not hike again. Bond yields correct, then again the recipe for further hike starts building in. So it's a very circular argument. Now, looking at where the consensus is, so they might be some of the dovish members in the FOMC community, but looking at what the consensus is telling, even if you keep aside where the current conflict in Israel, the current consensus tells you that the Fed as a whole, as a body, could still be looking at one more rate hike. Okay. And having said so, that could possibly be the end of the rate hike cycle, because now...
But then that elevated rate will stay for how long? We are looking at what, FY25 now, at least before a cut could be announced?
So I'll go by what the Fed did in September policy, because the minutes are nothing but a text version of their actions which were taken in September. And September policy, if you notice, Karthik, they reiterated the room for one more rate hike, possibly in November, because that's while technically they have 2 more windows before the year closes, but most likely it is going to be November if the rate hike has to happen, because September did not was a no rate hike, was a no rate action month. So keeping that in mind, they also projected that in the calendar year 24, they will be cutting rates down by 50 basis points, vis-a-vis their earlier expectation of 100 basis points. And these are Fed projections, these are not market projections. So the Fed is saying that I'm probably going to hike one more time.
Okay.
And I'm no longer going to cut as much as I said in June. So June they said I'll cut it by 100 basis points.
Taper it down, I think, is what the message is.
Taper it down. Yes.
Right.
So this essentially means that maybe rates are gonna stay higher, and maybe they are gonna stay for longer, because typically the shortest interval between rate hike and a rate cut for the Federal Reserve has been 6 months.
Okay.
So the markets currently at this point in time, if you look at the futures pricing, they are divided. The markets are not expecting a 25 basis point rate hike in November. The best that is getting currently priced in is somewhere close to 9 to 10 basis points. So basically that tells you that there is lack of consensus between market participants. And
Vivek, as much as I would love to have you on the show, continuing on the show, and as much as we love to hear you here on Newsline, we have run out of time on this show. We hope to get you back, in fact, very, very quickly on the show. But thank you so much for taking time out this morning.
Thank you so much.
Well, with that, it's a wrap on this bulletin. Thank you for watching.